fundsupermart.com.
So Brad, I want to start with your outlook. Where do you see EM fixed income going for 2013?
In terms of the outlook for next year, we're pretty constructive. The area we think is most attractive are the emerging currencies, which actually have been pretty stable this year. We think as we go into next year, the emerging currencies will be appreciating. That, along with the relatively high yield you get from emerging currency bonds, we think it's going to be a good year for returns.
Okay. Well, on the macroeconomic front, what are some of the possible catalysts or positive drivers that could drive emerging market fixed income, apart from currencies as well as high yield?
Yeah, I think the most important macro driver we see is what's happening in China to the labour force. In China, we've had this policy for over 20 years now, one-child policy. So as the children get older, we have less people joining the labour force. Actually, in 2 years' time, the Chinese labour force is going to start contracting. So Chinese workers have got pricing power. Wages are going up 15, 20% a year. This is going to lead to more balanced growth in China, and it's going to lead to opportunities outside China as countries look to take advantage of lower wage costs.
Okay, but in terms of risks, I mean, the most immediate risk would be of interest rates rising, even though the Fed has got a promise that they'll keep rates low for 2015, and there's always the issue of currency risk. What are some of the risks that investors need to be aware of and careful of before getting into EM fixed income?
Yeah, I think the sort of risks that investors need to be aware of are, what do the balance sheets look like of these emerging countries? Are they running big fiscal deficits? What's the political situation like? And actually, it's quite interesting. I was at the IMF meetings in Tokyo very recently, and the concerns about IMF balance sheet ratings, those concerns are in Europe. That's where we see the real stress and the real risk in the world economy. It's not in emerging markets, which by and large have got good and improving credit ratings.
Okay, so given this outlook that you have, how have you positioned the portfolio to take advantage of these forces?
Yeah, I mean, in terms of how we positioned our portfolio, we take a very diversified approach. We're looking at over 50 countries at Aberdeen Asset Management. I'll just give you a flavour for a couple of the countries we think are particularly interesting. Mexico is our largest position in the portfolio. Why do we like Mexico? As I mentioned earlier, Chinese wages are going up. Therefore, Mexico is a more attractive place for manufacturers to build new machinery, new plants. And also, Mexico is able to benefit from the very low gas price we have in the United States due to shale gas. So we're seeing Mexican exports to the US, for example, at record highs. That'll be good for the Mexican currency, that'll be good for Mexican bonds. So that's one area we find particularly attractive.